Hello again, everyone. It's 8 a.m. Chicago time on Tuesday, October 10th, 2023. I'm John Kosar from Asbury Research, and this is your Daily 5. These are currently my 5 most important charts, data series, and Asbury Research quantitative models that I believe are the most important to be aware of and potentially the most influential to U.S. stock market direction over the next several weeks to several months, potentially stretching into the end of this year. Let's begin with a brief recap from my last Your Daily 5, which was on August the 8th. In that video, I said several things. I said that the S&P 500 was testing formidable overhead resistance at 43.27, which we said was unlikely to be broken without at least a corrective decline first. We also said that a too bullish extreme in investor sentiment, according to the investors' intelligence data, also warned of a strategic market top. SPX subsequently declined by 5% into the early October lows. Finally, we also identified S&P 500 4200 as major underlying support. SPX tested this support on October the 3rd and has since rallied by about 3%. So here we are, situated just above 4200, major support in the S&P 500. I view these big technical levels like 4200 as special opportunities, as long as you can figure out which tactical tools to use to find the next strategic trend, hopefully before the rest of the market does. So now let's follow the money to try to look at some of these tactical tools. Number 1, the S&P 500 testing major support near 4200 as we said. Let's take a look at this chart and just kind of get the layout and see where we are in terms of support and resistance levels. So this is the S&P 500 daily going back to January of 2022. You can see the 200-day moving average is right here in orange. That is the major trend proxy. The 50-day moving average is right here in blue. That's the minor trend proxy. So what happened here is we broke out last June, really, the beginning of June, from this big sideways rectangle, let's call it. It was a congestion pattern. It indicated market indecision. We broke out the 1st of June. We ran up to test this resistance at 46.37. We fell a little bit short of it. This is when the investor sentiment was starting to get too frothy. This is right before my last Your Daily 5 in the early part of August. We had some sideways movement here, back and forth through the 50-day moving average, indicating that the minor trend was up for grabs. Nobody really knew what to do there. And then finally, we fell right into support here. So we've got 3 different areas that we're deriving support from. The first one is the major uptrend here from October of last year, October of 2022. That's currently at 42.76. We've got the 200-day moving average at 42.11, and then we've got the February and May highs of earlier this year at 41.95. That's major support. As long as we hold it, this larger trend from October of last year, it's still valid. If we break there, now we've got problems. Now we've got an emerging major bearish trend change, and we can see a lot more weakness. So what to watch for? 44.19 is the 50-day moving average. It's a minor resistance level. If we got back above there to turn the minor trend back to up, that would be a pretty good indication that the support has held and we're beginning another rise to maybe take another run at 46.37. But in the meantime, we have some indicators here that may give us a little bit sooner of an indication as to what this bounce that we've had from 4200 means. Number 2 is market internals. Asbury 6 turned negative on September the 18th. Those who know Asbury Research or those who see me on the internet for stock charts or some of the other places that I'm also seen on know that the Asbury 6 is our daily health check of the stock market. I actually built the Asbury 6 years ago when the way that the S&P 500 trades, the way the market trades started to change. There was much more day-to-day volatility. I think a lot of that has to do with there's more and more computerized trading. There's more and more algorithmic trading. By some estimates, that's 80% of the daily volume. But it doesn't matter why. It matters that it happened, right? So we needed better tools than looking at the S&P 500 and maybe volume or something like that to try to determine the health of that particular trend, the health of that index. So we started back testing my favorite tactical tools throughout my career, the ones that I had a lot of confidence in. We found 6 that work very well together as a team. That's the Asbury 6. We've got the rate of change in the S&P 500, which is, by the way, the only one that is immediately attached to the S&P 500 because we didn't want to chase the S&P 500's tail. The S&P's up 50 today, it's down 70 tomorrow. Very difficult to determine which of these moves is the right one to track. So now we're looking at other stuff. We're looking at relative performance of stocks versus high yield bonds, investor asset flows, corporate bond spreads, trading volume, and market breadth. It gives us a much broader under the hood look of what the health of the market is every day. Asbury 6 is updated every day about 2 or 3 hours after the close. It's available in our research center. And right now it's negative. It's been negative since September the 18th. You can see September the 18th here. 4 or more of these 6 constituent metrics is a directional signal in the Asbury 6. So right now there are 4 that are red. In order to turn this to green or positive, we need to get up to 4 that are green. We're not there yet. We're close on a couple of them, but we're not there yet. If we get a flip to green in the Asbury 6, that's going to be an indication for me that the internals of the market have gotten stronger. Strong enough to support a sustainable rally off of 4,200. So we're not there yet. We're kind of right on the border there. So we could very easily stay red here and go down and move through 4,200. But if we turn green, again, that's going to be a key indication for me that the market is healing internally and we may have the mojo to go higher. Number 3, sector rotation. The SEAF model follows the money in market sectors. The Asbury 6 answers the question, should I be invested and how much? The SEAF model answers the question, what should I be buying? SEAF stands for Sector ETF Asset Flows. This is another model that the first iteration of this model was probably 6 or 7 years ago when sector rotation started speeding up. Those of you that trade sectors know that 10 years ago, we would get these nice, long, comfortable trends where you get outperformance for 1 or 2 quarters in 1 or 2 of the sectors. So you had plenty of time to buy them after you saw them on your chart. You saw the relative performance chart start to do better. Plenty of time to get out. It's not that way anymore. Those trends have sped up. And I think, again, there's a lot more computerized trading going on. There's just a lot more activity intraday. So we had to come up with a better way to trade sectors. So we built this metric that rather than following the relative performance, which is what you get after the money moves, we started following the money. So we've got the 11 sector spiders here, and we built a methodology that tracks the velocity of money moving into and out of the 11 sector spiders, which together represent the S&P 500. We did it in 3 time frames. We have trading, which is weekly. We have tactical, which is monthly, and strategic, which is quarterly, and we rank them. So last week, this data is through the end of last week. It's updated on Saturday in the research center, and it's available for our subscribers so they can act on the signals the following Monday on the open. So you can see last week, the 2 strongest, the ones with the most aggressive assets in, were technology, number 1, and utilities, number 2. The biggest flow of assets out for that time period was consumer discretionary and energy, which are 10 and 11, so the 2 worst. And you can see for tactical, the 2 strongest, consumer discretionary and energy. Again, so you see a month ago, these two were very strong. A week ago, there was a lot of money moving out of energy and consumer discretionary. So it shows three different time periods, where the money's going, where it's coming from, and we avoid those where the money is coming from, and we move to those where the money is going, because money's the push that makes these relative performance charts work to our advantage as we're trying to find the right sectors to buy. So right now, the four strongest, so we have a scoring system, right? So anything from 3 to 15 is favored. 3 would be the best that you could do, right? Because it would mean all three across 3 time frames were number one for one particular sector. So the four strongest right now are technology, communication services, energy, and also consumer discretionary, XLY. We're kind of avoiding these right now because they had a tough week last week. That's where the money came from last week. So we're really mostly focusing technology and communication services. As long as the money stays there, we're going to stay there with it. By the way, last quarter, we outperformed the S&P 500 by 4.5% in the SEAF model, and that made the 10th quarter out of the past 13 that the SEAF model has outperformed the S&P 500, and it does it with about the same, if not a little less risk than the S&P 500. So if you're interested in this, you can find more information by going to asburyresearch.com and going to models across the top, and then going to SEAF model, and you'll see more details and some charts there that explain how all of this works. Number 4, market breadth. Weak extremes suggest an emerging tactical bottom. So what we have here is the S&P 500 on top, going back to April of 2022. On the bottom, we have the percentage of NYSE stocks trading above the 40-day moving average. It's a breadth indicator. So when breadth is strong, that's when 75% of these stocks are trading above their 40-day. When breadth is weak, that's when only 33% of them are trading above their 40-day. So we're in a weak period now. Why do we care? Because the past 3 that we had on March 13th, on October 13th of last year, and then here on June 16th, the middle of June of last year, those were all really important tactical bottoms. So what does that tell me? That tells me unless we're going into some kind of a prolonged downtrend, an atypically weak market here, which could be the war in Israel, it could be the lack of a Speaker in the House. There's always all kinds of politics and geopolitics that are swirling around. But this tells me unless there's something very terrible, atypically terrible, especially terrible, that is coming down the pike here for us through the end of the year, this plus 4,200 support that we're testing in the S&P 500 indicates a buying opportunity. And not only a buying opportunity, but a low-risk buying opportunity, because the S&P is trading at about 4350. So it's only about 150 points off of that support. Number 5, volatility, the missing ingredient for a market recovery. So this chart has the S&P 500 going back to April of this year, and in the bottom is the VIX, the CBOE Volatility Index. To us, the VIX is a tactical tool. So tactically for us is 21 business days or 1 business month. Strategic for us is 63 or more business days or 1 business quarter. So let's get back to the VIX here. And what this shows is the VIX moved up above its 21-day moving average on September the 20th, indicating a monthly trend of investor fear. Why do we care? Because our work shows, our back testing shows, that when the VIX is above its 21-day moving average, going back several years, the market has a tough time sustaining a rally. You might get a bounce, but as long as the VIX is above that 21-day moving average, the market struggles. Like look here, at the end of July through 2/3 through August, we had the VIX up above the 21-day moving average, and that actually gave us that first turn down from the resistance level at 46.37 that we talked about. That was the peak on July the 27th. Same thing here. So currently, the 21-day moving average in the VIX is 16.41. As long as the VIX stays above there, this rally is going to fail. This rally off of 4,200 is going to fail. If the VIX slides back down underneath the 21-day moving average, like it did here during June, which gave us this really nice rally during June, for me, that's going to be another green flag that it's okay to buy this now. Volatility has started to calm down, and now this rally can become sustainable. So a lot to process there, but basically 4,200 is a big line in the sand for the bull market that started last October. We have to have a couple of chips fall in place for us to get the all clear. We need the Asbury 6 to go back to green, and we need the VIX to move back below the 21-day moving average. But market breadth, according to the percentage of NYSE stocks trading above their 40-day moving average, is telling us this could be a great opportunity to move into the seasonal strength that we see typically in November and December. November's the strongest month of the year in the S&P 500 going back to 1957, and December's the third. So there you have a lot to watch, but the overriding thing here is I think there's some opportunity for those that have been waiting for a place to put money back to work. As long as we get these couple of indicators to turn our way, the Asbury 6 and the VIX, this could be the start of that fourth quarter rally that we're used to seeing in most years. So thanks for watching. If you like our approach to markets, please visit the Asbury Research YouTube channel and subscribe. And if you'd like a copy of the PDF, feel free to contact us. Go to asburyresearch.com, go to the contact tab, and ask for a copy, and we'll be happy to send it out to you. Thanks for listening. Have a wonderful October, and we'll see you with another one of these in about a month.